Hey everyone, thanks for tuning back in. Here's the update. Man, we got hit by a truck in September. The first week of September is down. There's already memes going around saying that the market has lost nearly $2 trillion. Yeah, $2 trillion it's lost in the last 5 days, I believe, of trading. So this is buck wild. My last video I was down negative 75. It jumped down to a negative 485, and at one point it was negative 513, I believe, throughout the day as I was checking this. Man, I got hit by a dump truck. I ended up selling off my Veralto position. I had 8 shares left, just under, I think, $800 or so, and I ended up averaging down in these other positions that I've had, because they were at the 52-week low. So man, I took a winner, cut it in half, because so there's a kind of an internal conflict with me about selling Veralto. So Veralto is a short term. I ended up selling it before a year, so I'm going to get taxed on it pretty heavy. But I looked back at it and I said, listen, it's already made me over $100 something. If I sell now, it's going to get taxed a little bit, but I'm still going to walk away with more money than I had. Now, another part is that I only had those 8 shares left. I had 10 originally. I sold 2 to fund some of these other positions, and then I got rid of the other 8. And the reason is because if Veralto goes to $200, awesome, I made a killing, right? But the idea or the likelihood that it would double, it would do 100% return is very unlikely. It would be growing at a great rate. I think like around a 12 to 16% rate, it would grow year after year. But the money that was used for that is nearly almost $1,000, and I don't think that I would be maximizing that punch. Now, Denison Mines, Arcadium, and Lithium Americas, I feel confident. All of the hedge funds have got into these. Big money has moved into them. The person who actually runs the fund for Sprott, they are experts, and they all picked these up. They got in at probably twice as much as what I have now at my cost per share. So I feel like I'm in a really good position moving forward. Now, I averaged down heavy. I took that $700-800 and I added to Lithium, Arcadium, Denison Mines, and I added some QRT. I did 500 shares. I averaged down to 60 cents per share, and the 52-week low was 40 cents. So I'm just 20 cents above that. I would like to get it down in the 40s moving forward. It hit 50%, 50 cents a share, which is really, really good. But at this point, at 500 shares, I need to get this as low as possible before I add another 100, 200, 300, 400, maybe even 500. Not sure. But I did want to lower it. I think it was at 70. Actually, it was at 69 before I had it, I believe. And then in Denison Mines, I got it up to 300. We're at 155 a share. The 52-week low is 138, so just a couple of cents over. Arcadium 261, and then this one was at 219, and then the other one's at 275. This one's at 226. So that's kind of high, but it's okay. Moving forward, again, this is the first week of September. I get excited because I can average down even more. And then if I'm holding long term, at some point the stock is going to turn and it's going to go higher. And every dollar that it makes, I'll be making whatever shares I hold. So it's kind of, I always hear the arguments about, don't average down. It's going to be a money pit. You're just going to keep putting money into it. And I understand that. But I think that the due diligence has already been done by those companies. They bought them because they saw value in them. Long term, we're going to hold, and that's what we're going to do. If there's a run in uranium or lithium, it's going to benefit me. And, we could really make some potential gains. There's a lot of risk to this, but also the reward is good. And I kind of remind myself in the last play that I had, I bought Nubank, which is a bank in South America, a digital bank that Buffett had bought, and I followed him. He bought in at 10. It sunk down to $3, but I said, listen, there's value in this bank because one, Buffett bought it, and he's already done all the due diligence for me. So I just continued to average down, and I think I've told the story. I went from 100 shares at $9 a share, and it started to sink. I continued to buy until $3 a share, and today each share that I bought and I averaged down to $6 has gone to 14. It just peaked at 15, and I've been selling some because of the return. It's at 220 something percent return right now. I have half of what I bought. The first, I remember selling when it hit a 200% return. I remember selling off what I initially put into it, and then that has grown tremendously, another few $1,000s. So I kind of remind myself, listen, the due diligence is already there. It's just buy and hold, get rid of them when they start to run. It's pretty simple. Picking the stocks is something else. Now, there's all different kind of ways to make money in the market. A lot of us tend to, like the one where it's fast. I kind of see that I've done all kinds of different investing, and this one I believe is necessary to grow your portfolio faster. And that's what I'm trying to do. You can always buy the Berkshire Hathaways, the S&P 500. I buy those too, but that's where you have a lot of money and you're not trying to lose any by continuing to buy more. And it slowly grows, right? These trades, I should say, these swing trades are what kind of pushes your portfolio. Again, in that if I didn't buy the new bank, if say I bought the new bank and then I saw that the share price went down to $5 and I lost half of my money, I would have freaked out, sold, and I would have just been negative whatever I put in, that $3,000 that I put in. Had I not stuck it out and sat on it for another year, I wouldn't have had these outrageous gains of what I have now. And I kind of remind myself that the market goes up and down. Entry point is extremely important when you buy a stock, because that's going to determine if you're going to make profit or not, right? If you look at your portfolio and you pick any stock, at some point in the stock, the life, as that stock has been selling year after year, decade after decade, there's a high and a low point. And if you got at the bottom, you made money. And if you got at the top, you lost money. And that's just as simple. It goes across the board on every stock that you own. If I just do this experiment, go into your portfolio and look at a position that you're losing right now, and look at the life of the share, the price, the share price. If you would have gotten at a different time period, you would have had money as opposed to what you did now. So averaging down is super important. I know it seems like a never-ending pit because it's so hard to average down. Again, I'm in the 200, 300 share range now. It's going to be super hard for me to move this cost per share down and closer to the 52-week low as I buy more and more and more. But it's necessary, and that's what we're going to end up doing. We're going to stick to our guts. It's negative $485. I feel not good about it, but at the same time, this is trading. And like everyone says, I think Ackman had said it. Everyone has the capacity to make money in the stock market and buy stocks. No one has, very few have the stomach for it. And this is one of those times where it's just, it's negative 85, 485, and you're just sitting there like, oh, I made the wrong decision, but I didn't. This is the ebb and flow of the market. I should have been on my game, and this is a lesson learned. Coming into September, the market was going to historically has been really bad.